Hi, and welcome to my monthly market insights video. My name is Dan Timitich, managing principal and a portfolio manager at T2 Asset Management. Before we get started, this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of others. You should always consult a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, so after experiencing a pretty good start to the year in the first quarter, the market just continued to grind higher throughout April. As a matter of fact, the performance in the month matched the performance of the entire first quarter. Optimism around earnings, more stimulus, and the reopening of the economy propelled the stock markets across the board. S&P 500 gained just over 5%. The Dow Jones Industrial Average was up 2.7%. And the NASDAQ gained about just under 5.5%. What was interesting to me was the lack of performance from small caps, which only gained about 1.8% or so. Could this be that canary in the coal mine environment? I think it's too early to say. But if the market is optimistic about earnings and the economy, it would only make sense that small caps do quite well, and that just wasn't the case in April relative to large caps. That said, small caps have had a phenomenal year thus far, so this could just be a one-month anomaly, but it is something that's worth keeping an eye on. S&P 500 companies have begun reporting earnings in April, and they have been strong relative to estimates so far. That said, companies like Apple, Microsoft, Amazon, they all saw their stock prices sell off following their earnings report, even though their earnings were pretty stellar. Why is that? Is all the good news priced into these stocks? Is this as good as it's going to get for these companies? I think there's going to be a number of things that we can point to. First and foremost, it appears that COVID is no longer going to be the tail risk for the markets. With vaccines available to anybody that wants one, and with over 100 million people vaccinated in the U.S., the markets are looking well past COVID and the shutdown. What I do think the market is not looking past is inflation. Inflation is now the single biggest tail risk, in my opinion, at least for the markets as a whole. I'll be talking more about this in detail in just a minute or so. One thing that companies are saying is the difficulty that they're having in finding employees to fill jobs because of the supplemental unemployment benefits that Biden recently passed. Here in Florida, as an example, people are getting paid more to stay home and collect unemployment than they would be earning at work. So this has forced a lot of businesses, small businesses here in Florida at least, to cut their operating hours or to simply just close additional days in the week. Some are even closed 2 to 3 days a week. We also have heard on these earnings calls that the supply bottlenecks continue throughout many industries, whether it's industrial, staples, all the different sectors are experiencing some sort of supply bottleneck. With demand strengthening and supply limited, that's basically the definition of inflation. You just have more dollars chasing fewer goods that are available. And also on these earnings calls, CEOs continue to be worried about inflation. They've mentioned inflation more on these calls than they have since 2011. I think the number of mentions on these calls jumped 800%, and that's clearly going to be pointing to higher inflation. As a matter of fact, the CEO of Whirlpool specifically stated that they raised prices on their goods anywhere from 5 to 12% because of the raw material and freight costs. And now he expects inflation to run somewhere between 4 to 5% as opposed to the 2-3% that they expected earlier. Now, before I get into go down too far to the inflation path, I just wanted to take a quick look at market valuations. Here we have a chart of the PE ratio for the S&P 500, and as you can see, there's been an unbelievable expansion of the ratio since March the 2020 bottom. The PE ratio is the price to earnings ratio. When you buy stocks, you're buying earnings. The price you pay for those earnings matters, and the PE ratio basically identifies how expensive or how cheap these markets are. As this chart shows, the average PE for the last 3 years or so has been somewhere around 23, as this black line here shows. Today, the number is 44. That means you're paying nearly twice the price for the same amount of earnings as you did back at the end of March. The last time we saw these numbers was back in the tech bubble of 2000 and the financial crisis in 2008. And while many people today keep pointing to stimulus and low interest rates and whatever other justification they have for these outrageous valuations, these same people said the same thing back in 1999 and in 2007. valuations do matter. It may not seem like they matter sometimes from a month to month perspective, but eventually they do matter. And I just don't want anybody to be surprised when they see these stocks come back to more reasonable levels. So, what's coming on the horizon? What can really spook the markets, I guess, and force it to reset? Well, the Biden administration is pitching another $4 to $6 trillion spending package after just spending $2 trillion a couple of months ago. While some people think that this may not happen, the last $2 trillion was passed without any support from Republicans. So this additional $4 to $6 trillion has a really good chance of passing. What's interesting to me is that the economy is doing quite well, and even states like California and New York have already said that they were going to open up fully sometime by June of this year. If the economy is doing well and all these states are opened up, why do we need this additional $4 to $6 trillion stimulus package? Now that the entire country will basically be open, I think there's no question in my mind that the velocity of money is going to increase. Basically, the multiple that money circulates throughout the economy. The trillions upon trillions of dollars that has been pushed into this into the system, it's going to have to start to multiply. And once this velocity picks up, so will inflation. We've already seen a lot of inflation, and that was without any of this velocity picking up. Once the velocity picks up, the inflation levels should only accelerate. And obviously, higher inflation is certainly going to lead to higher interest rates, no matter what the Fed tries to do. Trying to control the long end of the curve is going to be very, very difficult, if not impossible. And finally, with higher interest rates, stocks are going to have to reprice at lower rates. So I talked a little bit about inflation a month ago or so, but I wanted to revisit the topic given the Fed has continued to claim that inflation is very low and any increase in inflation will be transitory. I'm not sure, how confident they could be in calling inflation transitory, but we're going to go with it. But here we have a chart for the year, as of the beginning of this year, that have some important inputs to see how prices have changed over the year. Here you can see lumber prices. They're up 100% just this year. Aluminum prices are up over 68%. Steel is up over 60% or nearly 60%. Gasoline is up over 40%. Copper is up nearly 30%. And the entire commodity index, if you took it as a basket, it's up over 26%. And that's just since the beginning of this year. Now, if we kind of look back over the last full year, looking at these prices, lumber is up over 300%. Aluminum is up nearly 300%. Steel and gasoline are up nearly 100% each. Copper is up over 80%. And the entire commodities index is up over 50% in the last year. Folks, this is inflation no matter what the government tries to tell you, and eventually it's going to work its way through final goods prices. I brought this slide back from my last video, and I just want to go through it real quick. When the economy first shut down, the Fed dropped the rates to zero, so check. The Fed then went on to monetize our debt by buying back all of our bonds. Check. These actions all forced investors and others to take on risk. Check. We've seen what happened to the stock market and other risky assets. Wall Street then became much more creative with their vehicles. Most of you guys have heard of the SPACs, the special purpose acquisition companies. Check mark to that. This is a way for a lot of companies to go public, even though they don't have any earnings, but they just have a pool of money that's chasing after these great deals. And then eventually you're going to have inflation start to show up and interest rates are going to start to increase higher. This is basically where we are now. The beginning of May, we saw a little bit of pressure on the market here in the early days. We'll see if this is the beginning of a sell-off or if it's just something transitory, like the Fed would like to say. And then obviously once the selling begins, stocks are going to start to fall and it's going to accelerate until they hit a level that's much more reasonable, at which case then institutional investors will reload and buy these stocks at much more reasonable levels. Now, you may be asking yourself, why are interest rates and inflation so important when it comes to stocks? Bonds are bonds, stocks are stocks, so why would one influence the other? First, let me be clear. The bond market drives everything in the financial markets, period. I'm going to walk you through an example on how that works, and I hope it provides some clarity on valuations and interest rates and the relationship between stocks and bonds. So First and foremost, discounted future earnings is a way to value a firm's worth based on what they're going to earn in the future. And since earnings are in the future, you have to discount those earnings by something. And that something is the risk-free interest rate. And most people in the market, they use the 10-year Treasury yield. That's the risk-free rate. So here's the formula for the discounted earnings model. E1 is basically the earnings for the first year. E2, these are all on the numerator, the top line. E2 is second year earnings. E3, 4, and 5, each of the respective years. Now, year 5 earnings also include the sale of that firm at a terminal value. So year five also includes not only the earnings, but the sale price. Now, each year's earnings are then discounted by the risk-free rate for that given year. In year 1, for example, you would just divide that earnings by the 1 plus the risk-free rate to the 1 power, the first power. Second year earnings, you take 1 plus the risk-free rate to the second power. Third year, 1 plus the risk-free rate to the third power, the fourth power, and the fifth power. So for this company, we're going to take a look, and this is my hypothetical company. In year 1, they're going to earn 50,000. Year 2, they're going to earn 60,000. Year 3, 65. Year 4, 70,000. And then in year 5, they're going to earn $750,000, which includes not only their earnings, but the sale price of the company combined. So now let's do a little plug and play here. Top line, we put each of those years' earnings in there. On the bottom line, we're going to use 1% as the risk-free rate because that's where the 10-year Treasury yield was at the beginning of this year. And then after doing some math, we quickly find out that this company is worth $952,000, $952,000 and change. So now we're going to do the exact same thing, but this time instead of 1% as the risk-free rate, we're going to go ahead and use 3%. We're still going to plug in the exact same earnings because we're going to assume that the earnings are absolutely perfectly forecast and they will not change. So if you just change the 1% to the 3%, again, you do a little bit of math, and next thing you know, this company is worth just under $874,000. So the difference between 1% as the discount rate versus the higher 3% discount rate shows that this company is worth 8% less just by that small move in interest rates. Now, in the real world, there are a lot of companies that are that have forecasted earnings that are out 10 to 20 years. You know, in our example here, we just used 5 years, and you can see how sensitive the value of a company is over just a 5-year period when interest rates move. Obviously, the more out you go, and a lot of these companies that don't have earnings, you're required to extrapolate earnings that are 10, 15, 20 years out. As soon as interest rates move higher, those valuations are going to get hit significantly, much more significantly than others, just because of the lack of earnings transparency. So I hope this example provides you with some understanding between interest rates and stock prices. You can use this same method to value an individual company, or you can do it as an entire basket of companies or an entire index. I mean, earnings are earnings, whether it's one company or a basket of companies, it really doesn't matter. It's just a matter of establishing reasonable earnings expectations. So to conclude, be careful. We have come a very long way over the last year, and you should start to reevaluate your risk tolerance. I've been reducing exposure to stocks over the past month or so, and I'm going to continue to hold a larger allocation to cash until valuations become more attractive. I think everybody should prepare themselves for higher inflation. I know everyone is using the term transitory, but everything is transitory. When President Lyndon Johnson pushed through the Great Society programs in the 60s, GDP was nowhere near as strong as it is today, and that led to hyperinflation in the 70s. I mean, those were levels that could never have been imagined at that time. So was that transitory? If LBJ's programs created that kind of inflation, just imagine what could happen when you have $10 trillion of spending in the last, call it year. And when inflation comes, higher interest rates will follow. We just went over the implications of higher interest rates on stocks, but let's not forget, as interest rates rise, bond investors are going to get hurt as well because the price of bonds falls when interest rates go up. And then again, you can't just keep spending at these ridiculous levels without raising taxes. The Biden administration has a spending plan, and that comes with additional trillions and trillions of dollars of new taxes. It'll certainly be a huge headwind for the economy, and therefore also have implications for stocks and for individual companies. And then finally, don't be greedy. I know it's easy to get caught up in the hype, and when pundits are talking on TV every day about hitting new highs, the market seems to just completely be ignoring this tax and spend plans of the administration, thinking that it's never going to have a chance of passing through Congress. But they've made it clear that they're going to push through these tax and spend plans through a reconciliation process if necessary. Democrats control the House, the Senate, the White House. They don't need Republican votes to get any of this done, and they've already made it clear that if they have to do it alone, they will, just as they did the earlier $2 trillion package from earlier this year. So, as always, thank you for watching, and if you have any questions or comments, please feel free to give me a call, drop me an email, whatever's easier. Hope you guys stay safe, enjoy your spring, and I'll see you next month.